So, hello everybody. Welcome to today's discussion. Today we'll have quite deep dive into a topic on how institutions are deploying digital assets at scale today in 2026. My name is Alexander. I'm Chief Revenue Officer of one of the world's largest staking and yield provider, P2P.org. We are working with institutions across the globe, supporting almost every large exchange, custody, and wallet provider in the market. And today, with me here, Miles, Harrison probably will join us later, but we're happy to introduce you John from Fireblocks. Fireblocks is an absolutely unique player in the market. It always makes me hard to explain to people what Fireblocks is. Is it a custody? Is it a Microsoft Office for custodians? What is Fireblocks? But how we explaining what is this company today, beyond of being one of the loveliest brands in the market for institutions, Fireblocks definitely is an ultimate room for connections and for integrations with the all digital service world for institutions. And also today with us is Patrick. Patrick, who is CEO and the founder of Ampli. And Ampli is staying at the real frontier of the modern world. This is a company which pushed forward both technologies which we in P2P love more than any other technologies. And this is the Web3 on-chain stack and AI. And Ampli makes agentic economic real. That gives to institutions access to agentic transactions and to the overall agentic world. So it should be, and I believe it would be extremely fun, interesting, and deep conversation. And before we start, let me give you a couple of minutes, guys, to make an introduction. So, John, if you don't mind, can you give us a color? What's your role in the Fireblocks and how you currently look into the digital space?
Yeah, sure. Very happy to. Thanks. Great to be on with everyone. So, yeah, my name is John Hallahan. Work for Fireblocks. For those not familiar with Fireblocks, we're the largest provider of digital asset infrastructure. So, powering over 3,000 businesses, including some of the largest crypto-facing businesses like Revolut and eToro, but also, many banks and asset managers and regulated institutions. So really, we're providing that kind of core infrastructure for customers to launch and run their digital asset businesses. My role is head of business solutions. Essentially, what that means is I support our strategic customers in getting live with crypto and digital assets. So really, that's working with regulated institutions, banks, asset managers, financial market infrastructure, and fintech platforms. So going from POC to production. So one of the most popular topics that we're discussing at the moment is how you get from custody to yield. So hoping to bring some of those insights into the discussion today.
Thank you, John. Thank you, John. And Patrick, can you also share with us a bigger context what Ampli is doing for right now, where you are right now, guys? Because the industry moving extremely fast, company scaling extremely rapidly. So how the overall agentic environment looks today?
Sure. So hi, everybody. I'm Patrick Delaney, CEO of Ampli. And we are looking at a very, very similar issue as the one that John just framed, like how are assets being deployed into decentralized finance nowadays and how are they looking for yield. We are building solutions for agentic capital management. That means we are answering the question, how can I trust an agent with my money? Which is a very, very tricky question. And we believe that what Fireblocks pioneered back in the day for DeFi deployments in general can apply to agentic capital management from now on and in the future. And that's what we've been building over the past year at Ampli. And I would say, regarding the topic of today, how are institutions deploying? They are not deploying with agents at scale yet. And there is a space in DeFi with several great intelligence providers, Giza, Ziff AI, Sail, that have been coming up over the course of the last 1.5 years, that have been making great progress with mostly retail users, and they move billions in dollars in volume, but the total AUM kind of capped at around 100 million last year. And one of the reasons we believe that kept relatively low was that there was no institution-grade way to secure the execution of these agents. So that's what we've been busy solving.
Thank you. And well, Patrick, if you don't mind, I have an immediate question for you because, well, we are thinking about institutional world as a service provider. We always have to consider a huge gap in between of getting a deal, making a decision on the client end, and the real on-chain deployment. And this gap requires a huge operational effort from the customer side, from service provider side, and in a specific area of AI driven systems where you guys operate. Can you give us more color and context how your clients, your institutions who want to deploy capital today and bring this capital on chain through AI driven systems, through agents, what do they underestimate about this process? What are the biggest kind of gaps they are not overseeing in advance, and what you probably can highlight for us and for them in the future? So what are the hidden areas on this path?
One of the things that I think might like slip through the cracks and not really, is being paid enough attention to is how the agent permissions are being secured. That there was one of the things that we noticed when we were looking at the space early last year. Originally, our company wanted to build our own retail facing application using agents in the back end, and we very quickly realized that the whole execution security and the whole wallet stack around that was not really fit for purpose, but more like pieced together with existing products that were not built for agentic use. So I think this is one of the things that kind of like everybody looks at, oh, can this get me better yield? This is like, I think the worst question you can ask. The better question would be, can this mitigate the risk that we are already facing if we are exposed to DeFi, right? Which the agents can. They are great risk managers. They watch the market 24/7. They pull out quicker than any human can. And then the next question, could this bring me better UX if I'm a retail-facing product, like a neobank, for example, which is, I think, like one of the other main things that an agent can do for you once you mitigated the new risk that the agents brings. And that's like, I think the first time you look at it, you might come from LLMs and you think, okay, it could hallucinate, which most of these systems don't do because they're very, very purpose-built and far from the LM systems you've been running on an open claw right now. But oftentimes the so-called session keys that control the permissions of the agents are stored on some centralized server with the agent provider. So you have like a huge risk silo there where everything is in one place. And if ever that gets compromised, very quickly, the attacker would have control over everything. So we decided it is important to be a trusted service provider here that breaks up that risk silo and it takes away all of that like execution risk. And yeah, I think that's one of the main things that institutions would need education on.
Mm-hmm.
That at the same time, it's happening super quickly. Like I feel like the whole AI parabola makes everybody very agile and on their toes. So yeah, it's actually been going really, really well.
Mm-hmm. Yeah, that's quite interesting. While it's like two universes moving in the parallel. In one side, in every company, almost 50, 70, 80% of the people using LLMs in their daily routine. But from the company enterprise side, it's still much less adopted. So it's kind of a very controversial world where the employees already using the systems, but their companies still cannot adapt it. But we'll come to that later. And thanks, Pavel, for joining us. Glad to welcome you. Pavel is the head of product and growth and innovation on the Amina Bank. Amina Bank is highly regulated, European-based, institutional-oriented bank. And the fact which I love more is that Amina is also our partner and client. And Pavel, while you just joined it recently, we started to talk about deployment and gap which institutions face in between of getting mandate and real operations on the on-chain. So could you probably help us to understand how it works from the banking perspective? Like Amina Bank is regulated institution, and you guys already have a live staking product. So what it did the first quarter from the operational side, what probably you underestimate, what surprised you when you came from a mandate, from a decision which were made to real operations?
Thanks so much, Alex. And yeah, we're maybe just give a bit of a background in terms of Amina. So I think the term that we like to use in the bank is that we're not just a bank any longer. So we're a financial services group. We have multiple entities. Obviously, the one in Switzerland has the highest ranking when it comes to regulation. So we have a full-on banking license with an ability for us to custody, trade, stake, and do some other interesting things with digital assets, in addition to all of the fiat services that you would have regular banks do. So we hold a similar license to the UBS and some of the other Swiss banks. And then we also have a MiCA license, which was recently, it's been 6 months already, so it's not that recent, from Austria. We're also in the process of acquiring a PSP license, which would allow us to do more in the sphere of stablecoin transmission, cross-border, et cetera, which is a very relevant use case these days, right? So it feels like everybody wants to do stablecoins, orchestration, et cetera. So since we are the OG orchestrator of stablecoins and other digital assets, this is quite relevant for us. We also hold an ADGM license out of Abu Dhabi, well, kind of offshore ADGM structure, right? And then we also have a 149 plus uplift out of Hong Kong, and that I think is a very interesting closed loop infrastructure on the regulatory side of things. So we're effectively able to move funds and digital assets across multiple jurisdictions. And then obviously we're painstakingly waiting for any type of regulatory clarity, so to speak, out of the US, with hopes and prayers that potentially we'll be able to do something there as well in the near future. And then coming back to your question, Alex, I think operationalizing staking is not new for us, right? We've been doing this for a few years now. We're actually, I think, with the addition of Atom, I think we're at about 10 different protocols that we currently stake. We do this together with PTP and some of our other partners. So it's full on delegation. We rely on our partners to run the nodes. And then we delegate the stake to our partners. And then we've built a number of integrations internally. So our stake positions are reflected in the core banking. And then it's either through a direct integration via our custody service providers, or if we do activations through Wallet Connect, et cetera. So our team is highly skilled from that perspective. I think the interesting discussion here is, in addition to the agents and all of the agentic finance that is clearly coming, because we've seen a number of announcements, I think a very big topic for banks or for TradFi to solve as well, depending on the licenses, is how do we move on chain, right? Because in the current setup, we operate more like a centralized exchange approach. So centralized order book, we source our liquidity from our liquidity providers, whether it's centralized exchanges, OTC desks, etc. But then obviously we are not as efficient, not as nimble as some of the DeFi solutions that are out there. So this is something that we're exploring together with P2P. I can talk about this openly. And then obviously, how can we create, I would say, more interesting earn solutions enabled by DeFi, right? How do we build these solutions that are both compliant and safe? I think is the most important topic for us. right? We do want to make sure that our clients' funds are segregated. We know exactly who we're interacting with. We know who our clients are interacting with. And then how do we make sure that if it's a borrow lend instance, that collateral stays with us? We minimize the smart contract risk as much as possible. And we make sure that the funds are not commingled. Whatever liquidity comes from the other side is KYC'd, et cetera, et cetera. So same rules apply. We just have to replicate them on chain.
Thank you. Yeah, and while we are talking about DeFi or even in agentic interactions, in the institutional world, the elephant in the room would be regulatory landscape, and we'll touch that as the next part, because this is the hottest, the most controversial problem of the industry by the last decent of years. But before we move there, really want to make the full, complete picture from the market and understand also, John, from your perspective, from the Fireblocks perspective, how do you oversee challenges, issues, what your customers are underestimating in terms of operations when they're interacting? Would it be in the staking? Fireblocks was one of the first, even probably the first intermediary platform, which in early 2018, 2019 allowed staking to your customers. Or while we are currently moving to DeFi, institutional adoption, then agentic service institutional adoption. So all these services, they are moving through the same path, right? We got a key players on the market, platforms which as a cornerstones, connecting service providers as P2P with the customers, with the capital holders. So how do you see this operational challenges?
Yeah, sure. I think it's a good question, and it's a pretty topical one in light of, well, we have MiCA obviously in place now, but other regulations that are following across the globe. I think the kind of key issue is never technical, right? So I think what's true is that, you know, signing or staking from an institutional wallet is a pretty well understood process now, I would say. So you've already referenced that Fireblocks and other types of platforms have been, I guess, delivering those services for a number of years. I think where it breaks down is across three different areas. So the first one is around policy. So like if you're a company who's, let's say you're ETH staking versus ETH trading, the policy rules around that are very different, right? So if you're a regulated institution, you need to prove things like that you have a whitelisting process, you have a way to approve any changes, a way to actually approve any staking. And that kind of operational burden is something which takes quite a while to set up. So we see that as a stumbling block for many institutions. I think the second one then is around the kind of operational side. So, and that's mainly between the validator operator and the institution. So what's the process for unstaking? How do you monitor slashing risk? Who reconciles into kind of core systems on rewards, et cetera, et cetera. These kind of things that, you know, until you're actually staking large amounts of funds on behalf of customers, you don't really come up against. So I think having that operating model, which is like more of a process thing than a technical thing, I think is really important. So a lot of our customers who are quite scaled on staking have that operating model down very well in advance of doing that, and choosing your validation partner or your initial partner and then expanding, you know, you follow that same process. And then the third one is the kind of regulatory piece, right? So in some jurisdictions, staking is interest, in others it's a service fee. You know, understanding that if you're across multiple jurisdictions is something which is really important, right? So I'm sure Pavel can definitely tell us more around that. And compliance teams want to see that mapped before anything is signed off. So I think like in terms of making a decision versus getting something into production, we see those three areas as big stumbling blocks for many institutions. So the technology is not really the difficult part. It's those kind of operational processes you put around it.
And let's go further on the regulatory side. So you're based in Europe. You're leading the European part of the Fireblocks team, but still, Fireblocks got an absolutely unique perspective on the market. You operate globally in all the jurisdictions. You have to act within multiple, not always clear compliance systems and regulatory landscapes and regulatory frameworks. Talking about the European segment and MiCA in particular, can you say that from your perspective, it already brings a clearance to the market? Is it does it go standardized from the client perspective from your point of view, or it's still very individual?
Yeah, like I think what MiCA provides is a very clear framework around authorization. So the licensing perimeter is very clear. So you understand you need the castle with authorization. You understand the difference between custody and staking. So I think from that perspective, the regulatory position is quite clear. But I think, there's no two companies are kind of treating it the same, right? So each compliance team is slightly different. Each level of risk is a little bit different. So every tier one that we work with is interpreting MiCA's staking provisions in a slightly different way. So we're not trying to make them harmonize on any one approach. We're just kind of supporting them on, I guess, giving them the tools to have policies and operational processes that you can put in place based on the infrastructure. So I think it's clarified the licensing, but things like accounting treatment, capital treatment, how staking is characterized, they're kind of on an institutional by institutional basis. So those things I think are still more of the operational side are being worked out.
Thank you. And until we jumped, Pavel, with you into the rabbit hole of how MiCA works from an institutional perspective, Patrick, you guys working in between of two regulatory landscapes. On one hand, we have a MiCA, which regulates crypto and on-chain interactions. In another hand, here in Europe, we almost got AI Act on place, right? So you have to adapt your business for both regulatories simultaneously. Could you help us understand how that looks and works? Does it work at all?
I'm going to give you a very agile startup answer to this. First of all, we are incorporated in Florida.
All right.
So we're still waiting on that clarity. And also, unlike Fireblocks, we're not offering custody services. We are offering self-custodial solutions, and we view ourselves as a software company. And the agents, actually, adding a footnote to what Pavel said earlier, the agents actually have this sometimes overlooked property of having some regulatory benefits, because Pavel mentioned how you would want to avoid commingling. And I think that's more and more the case the closer you are to your client, the closer you are to the root layer. So the whole idea of vault solutions gets really, really tricky there, and which is like one way of how people want to orchestrate yield management. And arguably even in the US, these vault shares might not stand the Howey test. So having agents where each user or each client has their own segregated wallet with an individual agent that is treating their assets individually depending on the balance and preferences and policy settings, as John pointed out, that actually has some regulatory upsides that I think will kick into gear once we mitigate all the new risks that the agents bring, and also once we have more clarity on that AI side when it comes to regulatory.
Clear, thank you. Well, Pavel, from Swiss-based, highly strictly regulated, I can't imagine would it be possible and feasible to find more regulated entity in the world neither than Swiss-based crypto bank. Could you explain us how MiCA really helps you guys with standardizing a decisional making process? When your compliance team looking on the staking or on DeFi earn products, how their mind works? Do they have a clear roadmap, a list of checkboxes they have to fill, or isn't it a case?
Well, I think the whole topic of DeFi is a super interesting one, and obviously you and I are talking a lot about this in the background. I would say we definitely need to delineate the two. So MiCA is kind of a CASP regulation, which is the crypto asset service provider. And this is a separate entity for us out of Austria, out of which we effectively serve all of our European customers. And then all the new onboardings are going through that entity as well. And then naturally, there are limitations in terms of what products and services are we able to offer. Simply because, certain, let's take a case of USDT, right? So USDT is not MiCA compliant, therefore it cannot be offered to the European client. Same thing with Athena's USD, right? There's a restriction on offering that to begin with. Then, if you look at the Swiss service offering, then pretty much it's a full service across all product verticals that we currently carry, and therefore I think once our compliance is comfortable with offering a new product or a new service, and some of the other stakeholders, because it's a multi-stakeholder decision-making approach, then we run effectively like a second and the third check, so to say, or parameter check, whether or not we're able to offer these products and services, not just in Europe, but also, let's say, in Hong Kong, right? Do we have the capabilities? Is there sufficient regulatory framework? Are our suppliers that are also, in some cases, jurisdictionally driven, are able to support specific assets or products and services? So it's a bit of a patchwork. Let's put it this way. And then maybe coming back to DeFi, I think Switzerland, despite the fact that, as you completely correctly stated, that it's a highly regulated environment, despite all that, we need to go back to maybe 2016, 2017, the DLT Act, which was first of its kind back in the day before MiCA was even conceived or consulted. That was already in place. That was one. And then I think there's guidance on DeFi from the local regulator that goes back to 2021. And we are also, which I know from my compliance colleagues, are in constant touch with the regulator, their fintech desk specifically, when it comes to innovations around things like monitoring. So on-chain monitoring is a very important topic for regulators as well to understand and to keep track of. Any type of analytics, any type of KYC innovation. So we're actually looking at a super interesting solution that's coming out of the US, which potentially can solve both, let's call it the privacy topic, because privacy is an incredibly important topic for institutions as well. This is why Canton is becoming so popular. And then at the same time, it allows the regulators to untangle certain ZK proofs and really truly understand who that user is, what is the source of funds, what is the history of wallets, et cetera, et cetera. And the regulator is up to date with these initiatives, and we're in constant touch. So despite that heavy regulation, I think there's still a lot of very interesting things happening in Switzerland and beyond.
Thank you. And while you mentioned Canton, Canton is an excellent example of both best product for the time on the market, right? But also an extremely they, I think, could put their GTM into a playbook and share with most of enterprise sales teams in the market, because how they built their GTM strategy it was a stellar. And let's talk about GTM. How we are currently looking to the deals cycles, to the client needs, and to deal stoppers. That what really makes a big sense for all of us and for most of our viewers, because regulatory landscape, operations, and everything else at the end of the day should ideally help us, but at least not block us from running the business, from scaling the business. So at the end of the day, it's all about GTM, right? John, again, Fireblocks has been an absolutely unique player in absolutely unique position. I assume that you probably got the highest amount of institutional customers in the world, at least on the crypto world, because last time I've get a lot to participate on the Spark, which is the Fireblocks conference for the Fireblocks customers only. I was shocked with the number of people and companies being there. So you got a very decent and wide view on the market. So from your end, guys, when you're selling to your customers integrated earn products, staking definitely, which is the basic today, right? And I believe DeFi should came very soon to the field. What currently killed the deals in the late stage, and generally what blocked the deals? And on one hand, and on another hand, what forced the deals? So do you probably have some silver bullets you're using today and you can share with us?
Yeah, sure. Won't give all the silver bullets, but happy to provide some insight on what's happening. So I think what's interesting, yeah, you kind of referenced we've 2,500, I guess, B2B customers. But I think one thing which is interesting is we have 100 banks as customers. So I think, you know, a lot of the work that I spend my time with at the moment is working with banks through this process. And there's pretty much two things that come down to it if kind of deals are pushed out or don't happen. And I'd say at the start that it's very rarely, like the previous answer I gave, it's very rarely a technical issue. I think technical issues typically with regulated institutions are sorted out very early in the process. So by the time you're later stage, it's not really something which is a concern. So I think the first one is internal alignment at the customers. So I think Pavel has outlined it perfectly right. You've got so many different stakeholders that are involved to get a digital asset program up and running at a bank. You have a business sponsor, you have the CISO team, you have the compliance team, you have operational risk, you've got procurement, all these different kind of stakeholders who are involved in the process. So typically if a deal is stalling late stage, it's typically one of those stakeholders is putting up their hand and isn't comfortable with something. So that is definitely where deals can slip at the later stages. So I think one is just the complexity of these organizations actually getting something over the line. I think the second piece really is kind of scope creep, which I think is, you would probably class it more with crypto native or fintech players, but really now with a lot of banks that we're discussing with, you'll start off and you'll be really aligned on, we want to do custody, we want to do staking, and that's pretty much the scope. And then in the 11th hour, it's like, well, actually, we've been invited to do some stablecoin projects and we'd love to tokenize something as well. And maybe we'd like to do a POC in DeFi. And then that, I guess, level of complexity can kill the deals. So, you know, I think if you're renegotiating the scope of things late stage in the process, I think they're kind of the two. So what we're trying to do with a lot of these regulated institutions is have a very clearly defined scope, have that linked to a very clear business case. And then that's pretty much how we kind of go through that deal process. So they kind of be the two pieces that we see across the board. So
Let me ask you another one question. Then I will, if you don't mind, guys, will repeat it for all of you. So how the institutional sales works, one of the main rule is that you never got a one person in the company on the client side who can buy your product, but you always can get a one single person who can kill the deal, right? So you have to operate through this committee of stakeholders and sell to all of them. No one of them can make a single decision to buy, but any of them can literally block the deal. And looking from that perspective on the Fireblocks, and maybe you can share with us who's more frequently currently blocking the deals. What is the role? Which role we as the salespeople have to be focused more than others while we're selling earned DeFi products to customers?
Yeah. There's definitely no silver bullet with this one. It really differs across the board. Like, listen, I think who are the teams within like a regulated institution that could cause issues throughout the process? I think one is the CISO org. So I think you really need to be very engaged with the CISO org and help them understand, like particularly with a product like staking. Custody is easy, right? So lots of banks custody assets. So they need to understand the dynamics of using a wallet to do that. But staking is a very different product, right? So, and also playing with DeFi is very different as well. So I think getting the CISO team comfortable with that risk basis as a regulated entity, I think is one which is really important. And then I think, you know, typical for enterprise sales in general, regardless of what you're selling, the procurement team is always going to be the one where you could have challenges later in the process. So I think that they would be the the two stakeholders in particular, that would cause, issues on any types of enterprise deals with banks, I would say.
All right, thank you. So we have a CISA, and what was the second role once again?
Procurement, and
Procurement.
hopefully there's no procurement managers on the line, but that's definitely a big one that I see.
All right, thank you, Pavel. From your end, from the bank perspective, and you're selling staking products, earn products. When you will start to sell DeFi products to your customers, where do you currently stuck mostly, and which roles you think needs the biggest attention? Why I'm asking this question? Of course, we don't want to blame the CISA managers, but if there is a role which more than others currently blocking the deal, it means that from that perspective, we are, as the players, as the service providers, banks, custodians, any type of service providers, we definitely have a room for improvements, right? So we need to address more concerns of these particular roles. So if you can answer the same question from the banking perspective, I believe that would be very helpful.
Yeah, I think in general, it's very easy for somebody like me who's been in the industry for a while to basically just rely on the knowledge and insights that I receive, and I'm like incredibly passionate about our industry, right? And that's not always the case across all orgs, and I'll tell you even more, that's not even the case in our org, right? There are pockets of knowledge within the company that are pretty deep and sophisticated, but then when it comes to truly keeping up with what's happening in the space, it's incredibly difficult. And I think the processes that we've built, the tech that we've built back in 2018, can it be potentially optimized to today's standards? 100%, but that would mean that we have to redo everything from scratch. And we have, serious reliance models on a lot of our service providers. So I think we just need to get better, both as us as Amina as an organization, but also as an industry, on, let's call it the on-chain side, the DeFi side, whatever we want to call it, as well as on the TradFi side, to really try to understand each other better, I would say. So on DeFi side, I speak to all of the major protocols, and I think the questions that I receive from them, that sometimes the lack of understanding about topics like, counterparty risk, right? Who is the actual counterparty that we're interfacing? The fact that the bank cannot interface with a smart contract is a major topic, right? We need to have a counterparty with whom we potentially can take to court, right? Which is in case of things going down not the way that we would want them to. And equally on the TradFi side, I think we have discussions with other banks as well, because we offer B2B2C services, where we share our experiences and how we've set up our architecture and everything. And we see that even though we are closer to the source, there's still there's a gap in understanding. So I think the best thing that we all can do collectively is just host more events like this one, talking openly about different topics and solutions that we're building, educating, and then at the same time removing as much jargon as possible from our industry, right? So a very basic and funny example that I give to people is, in TradFi, RWA means one thing, and in DeFi, RWA means another thing, right? So it's same acronym, but it means different things, and that is the easiest way of showing how these two industries are not perfectly aligned for the time being.
Yeah, TradFi would go, well, we are in the real world. What are you talking about?
Exactly. It is the real world. What is that?
Is that
we're not in
That's
the
what we're
metaverse.
dealing with. We don't have Oracle risks.
Yeah,
exactly.
But Pavel, that was an excellent example of a very polite, very Swiss based answer to question which roles blocking your deals more frequently. But thank you for your perspective. Patrick, I think for you it makes sense to answer this question more broadly.
Yeah,
So,
indeed. I was going
yeah.
to.
Yeah,
Indeed.
thank you. So in general, the whole procurement committee, how it looks like, what are the challenges, what is the way of selling it, what changed within the last 6, 12 months, because the landscape changes truly frequently.
So yeah, since we are very bleeding edge with the whole agentic capital management angle, we gotta be very mindful of that and decide whom we are talking to and whom we are selling to very early on. And it's not banks right now. I can maybe illustrate that with a small anecdote. I attended Money Live in London earlier this year, and it's a very, very banking focused conference. And so far in these networking situations, I didn't experience any event where people were running away from me more quickly than the regional banker representatives did there at this conference. Because for them, they do have AI pilots, but their AI pilots are like, let's make this part of the back office a little bit more efficient. And then in some instances, they would do maybe like chatbots, but that's already considered very high risk because it's touching the end customer, right? So having an agent actually move funds around to them was very far out there. So you got to respect that. And then maybe as a second order consideration, as a startup, you got to realize that the sales cycles with a bank are very long. And as John illustrated for us, that can go wrong at a very late stage. And that could kill your company if you're relying on these few very, very big clients and big success stories too early on. So in our case, the wedges that we choose was the first wedges, fund managers that are already active in DeFi. Because
which size, sir, excuse me, which size of asset managers? Because there is a variety, right?
Yeah, we're talking to different sizes. I can update you next month, I guess. But like the main thing that they have in common is that usually they are more quote unquote degen than what you would think when you say institution. They are actually very sophisticated in terms of what they're doing in DeFi. They are also very mindful of the risk that they're already facing, and they know what they got themselves into. So for me, I can actually explain very easily to them that these risk management capabilities of the agent, the 24/7 surveillance, that's really solving a problem for them once we took care of the new risk that the agents bring. So that's like the easiest sell. And they are very high, like for a company as us, they're very, very high impact early customers. And then the other thing that's happening, and it's happening more quickly than I thought, would be new neobanks, where you don't face the whole issue of existing companies where they would have to migrate to a new system, et cetera, and integrate you into existing things and have the compliance all set. It's way, way easier if they're like fresh and they can actually build their compliance around what you are offering them. And that's happening more at the fringes, like in the global south, rather than in the MiCA regime. So Latin America, Africa, that's like the places where a lot of like tech adoption happened, and we kind of saw how retail users were actually skipping steps, right? They went directly to being online through the phone, skipped the PC era, and then they have all these low-tech financial solutions as well. So we think that the prospect of getting an upgrade of their phones to turn that into their personal banker while being sometimes unbanked in the traditional system is a really, really interesting vertical. And it's happening more quickly actually than I thought it would. I thought we would have to prove out with the fund managers first and then gain the reputation, scale the AUM. Actually, we're having more conversations like that very quickly than I thought we would when we started. And then maybe one last note on the whole compliance and what Pavel said, like the counterparty and the smart contract. I think if we like put our cypherpunk hats on for a minute, it is also kind of a paradox that we are now trying to sell the product that's supposed to replace this middleman to the middleman, right? No wonder that there's some friction there, right? And I'm not saying that that's not going to, that, you know, DeFi is not going to eventually turn into Fi. Very, very clearly it is. But yeah, it's going to happen in different ways with different actors involved.
Yeah. Patrick, you're absolutely correct. Sorry, I have to echo this because I I come from that world, and I've been with Amina for 2 years, but before that I used to build my own applications, and it's exactly that, right? I think the initial premise, and I remember how violent that premise was as well. If you go back in DeFi summer, it was we can do it all by ourselves, and let's not swear on the live broadcast. Screw the banks and all this stuff. It was there, and interestingly enough, I think for a moment in time there was hope that we were going to achieve that, right? And then somehow I think we went into another bear market, and people realized that I think we've reached certain, I would say, liquidity thresholds, right? So in order for you to unlock the next liquidity threshold, you would have to tap TradFi liquidity, and then you also quickly realize we've all realized as an industry, especially after 1010, is that maybe it's not just that we need to get the regulation through. We're not equipped for some of the, from the systems perspective for TradFi either, right? And 1010 was a good showcase of that potentially. So I think the intent of building an alternative system is a great one, and I think there's a lot of value that DeFi has brought to the table. There's tremendous innovation. I think smart contracts, we've all known and been there, done that kind of situation, but the fact that you can automate a lot of the decision tree through that is incredibly important, and I think that is something that needs to stay and needs to develop. And I think we will find that golden core where I think effectively where we will end up is regulated KYC liquidity will have its own path within DeFi on chain. Very similar, and Alex and I spoke about this as well, in how you see these parallelized flows in Solana, right? And at the same time, non-KYC'd liquidity, retail liquidity that doesn't necessarily require that, because I don't care as a user, as a self custodian of my own assets, where I source my liquidity, how do I borrow, how do I lend, how do I trade? It doesn't really matter for me. Then most likely I will have a separate path. And I think those two paths will likely coexist, and it will all happen on chain, hopefully. So at least I want to believe that.
Yeah, and I also want to address this paradox, as you described, that we are building a middleman for the middlemans. I actually can't agree with you, because I believe that what agents made first, agents gives a feeling that it's me. For either a company or a person, it doesn't give me a feeling that it's a middle layer, but it really associates with myself, even if I act as the company. And then even more, while I'm delegating actions to my agent, I start feel that this agent goes straight through the market and doing wherever he should do with an end system. So it even gives me more feeling that I reduced middlemen from all of this process. Like when I interact with on-chain, with DeFi world through my agentic ecosystem, it gives me a feeling, even if in reality you're absolutely right, it is a middleman for the middlemans, but it gives a strong feeling that I'm working directly, passing all the middlemans with the end product. So I think that's important. Agents gives to crypto folks and to companies this probably naive feeling that we are reducing middlemen, and in reality we are just moving all the middle players into an infrastructural layer where they interact through MCP APIs, with agentic world. But from user perspective, yeah, that's how it feels. And
yeah,
looks.
I mean, how I was interpreting it was more like that DeFi is trying to get rid of the banks as the middleman, and then the banks come back and they use DeFi on our behalf, right? Which is kind of weird. But what you're saying with the agents is also very, very true. And at the same time, I do think that DeFi always had that democratizing promise, right? And I think there is a chance that agents could unlock that because they solve the notoriously bad UX, and they can tear down these barriers to use. I think like the global penetration of DeFi is like 0.5% of the global population. Not like holding crypto, but actually interacting with DeFi protocols. That's tiny. And I think agents could make that number skyrocket on the behalf of humans. And that's like what gets me really excited. Is like we're building the blockchain systems with different intentions, like, you know, the whole Satoshi global financial crisis, all of that, and then Ethereum with the programmability that Pavel mentioned. And now we kind of battle tested this and hardened this for 15 years. And it was kind of painful, right? Like you were all sitting there signing a transaction that's larger and we're feeling uneasy about it, looking at the hex code. But now we have the infrastructure in place to have agents transact on it, right? And to create guardrails and to confine their movements, which I think is pretty crazy that is such a match, because it wasn't intended for that originally, right? Like I'm going to assume that. So
No,
it's actually
definitely not. Cool. It's like a really interesting convergence in the industry at the moment, right? So I think like the UX issue that you mentioned is looking like agentic finance is going to solve that to some extent. So it will just be embedded in normal applications and users won't have that UX issue. And then we have this regulatory position now across most markets, which means that like the actual people who own the assets are now moving on chain and curating vaults on things like Morpho and you know, working with Aave and others. And now we have these regulated settlement assets. Like you look at Kivalis today announcing like 24 more banks for 25 more banks joining that consortium, for example, to have a Euro stablecoin. So it's like all these market dynamics are now shifting to a stage where, you know, for DeFi and for yield, it's becoming a much more palatable proposition for organizations to move in. But naturally, users like us will have the benefit of that. Outside the fact that probably everyone in this call is very degen and already has the benefit. But it's like the mass market of users across these applications now, which are going to have the benefit of the technology. And I think that's it's the first time since pretty much Ethereum that's came around in 15 where there's this kind of really interesting shift in the market happening. And it's exciting to be involved in at the moment, you know?
Yeah. Coding is a very good analogy. We can use it because, you know, millions of people desired to build their own apps, but the entry barrier was extremely high always, and you will have to make mistakes, broke your apps before you will start to get benefits from it. Same with the DeFi. Millions of people want to interact with DeFi, but even worse, in DeFi world, you have to lose the money in the way when you're getting experienced, right? And I believe that will work in the same way. Like agentic ecosystems will just reduce anything. It will crush these barriers, and we'll see next hundreds, million, billion users in crypto who wouldn't be humans. Finally.
And it's not really going to be crypto either, right? Like eventually,
yeah,
like
exactly.
Larry Fink is running around saying all financial assets should be tokenized. We mentioned Canton,
markets. Right? Yeah,
it's going to be just finance eventually.
Yes, yeah, everything going on chain. New York Stock Exchange going on chain. It's at the end of the day, it's even right now. It's very hard to to draw a line where crypto exchange and bank are not clashing the markets, because we can think about Amina Bank as about crypto exchange. I can do the same what I'm doing on the OKX using Amina interface. Living in Spain, I can use the largest Spain banks, BBVA, to buy crypto, trade crypto, stake crypto.
Wow.
Yeah, just right.
I think I haven't kept up with that evolution on the personal banking side. Yeah, it's actually pretty crazy.
Yeah.
Yeah. It's hard
I
to
know
revolution
Revolut are doing it,
for
etc.
years already.
Yeah.
Yeah, it's a challenge. There's this like really interesting, it's like a convergence, isn't it? It's like TradFi and crypto, the lines are blurring more and more. And I think what's interesting is that like a lot of the larger crypto native providers, like the Krakens and Coinbases and others, are now either getting bank charters, they're buying securities exchanges, they're basically getting access to Fed settlement in the US, if you take Kraken, for example. So, you know, JP Morgan's biggest competitor isn't Bank of America or Citibank. It's probably like it's a Coinbase or a Kraken in the future, I think, or maybe it's a Robinhood or a Revolut. But I think that's access to digital assets and access to different forms of yield are giving them a much bigger one-up on the more traditional players.
And you can see that even in the behavior of the big banks in the US, right? Like the regional banks wrote this letter to Congress asking, you know, claiming that 6.4 trillion in deposits were at risk because of the stablecoin regulation that's coming. And the big banks didn't sign it, right? Like they're playing both sides because eventually they are, you know, prepared for a future where the regional banks are the ones that are being displaced by the new systems, right? So you can clearly see that. I always think it's really interesting that for the longest time, the most quote unquote bullish stablecoin market cap predictions we had were like Citi's 3.8 trillion. But now the regional banks in the US come out and they say 6.4 are at risk, right? So where are those going to go? It's stablecoins. It's pretty interesting.
Yeah, you've like regional banks that are falling behind, and then you've like people like SoFi, who we're working with, for example, who've like completely transformed their revenue basis by adding digital assets. So it's like a really the people who are moving early and have a very defined strategy and getting things to market, I think, are going to be big winners longer term for sure.
Yeah. And at the same time, what makes stablecoins so much attractive for TradFi companies, for TradFi people, is the size of yield upside. So it's very simple idea, right? That you can still use your USD, like convert it to digital USD, but then you can access to double-digit yield from that. And
depending on your risk tolerance, I'd say.
Yeah. But from customer perspective, you know, from the company perspective, most of the risks today already are wrapped. You can buy an ETF product, you can buy an ETP product, you can buy a share of a company which just converts their business into the shares, but in reality it still would be a hedge fund. You can buy a Athena token. Even when you're just
not on the MiCA, but yes.
Yeah, but still, I mean, that's an idea that depends by your risk tolerance level and your fee appetite. You have this choice today, and that's what brings people into not DeFi but into crypto today, into stable coins. And stable coins previously were never really considered as a part of the crypto. You know, through DeFi summer, we thought about crypto. For altcoin summer, we thought about crypto. We never thought about stable coins. We thought about tokens, protocols, networks. Stable coins is the big area. But from here, guys, I want to wrap this discussion into protocols layer, because that was always strongest narrative which pushed crypto forward, Web3 industry forward, a variety of protocols. New protocols arise every year and rise and fall, and this was the kind of samsara cycle of crypto. But last 12 months, probably even last 15 months, are different. There are not too many new protocols coming to the field. The protocols which in the past were sustainable, were promising, now losing an audience, falling on their revenues. If you look to charts of how much revenue, like top 30 largest by capitalization protocols generates monthly, some of them wouldn't even generate $1,000 today. But can you share your perspective, how your clients, your customers thinking about networks? And again, while all these discussion circles around earn and DeFi and staking as a part of that, how do your customers think about different networks in different options of getting yield on them? apart of Ethereum and Solana, there is, we can split it into sections. Like there is Ethereum and Solana, right? EVM protocols in one hand, and all the rest of the market in another. So, John, if you don't mind, can you give your perspective?
Yeah, sure. Like I think you've got kind of two key pieces here. So the first one is that, like, for institutions that are moving into the space, they want to use a brand which is well respected and runs well. So I think, like, from a protocol choice perspective, the safest thing to do on the earn side is to go with an EVM based chain or go with the Sol or maybe Cosmos, depending on what your appetite is. But I think fundamentally, like, the biggest point that we're seeing from our customers is, like, it's where their customer demand is. And like, to launch an offering in this space now and to be competitive as an institution, you need to cover all the major staking protocols that you can get on a Revolut or a Robinhood or an eToro, or else you're not going to be competitive. Mm-hmm. And then there's more of a choice around, obviously, the validator partner, because then the unit economics come into it as well. So I think it's driven by customer demand, number one, but then that flows then quite quickly to unit economics, because if you're launching something which, you know, is taking a higher fee basis, then you're just not going to have a competitive offering in the market. So I think they're the two components that we see from customers that are moving into the space.
Thank you. And Pavel, I kind of have a different question for you. From bank perspective,
I really wanted to answer that question as well.
No. This would be the same question, but answered from different angle. You'll be able to give us a broader answer. But I'm very curious to see your point, how, as the bank, you're choosing which protocols you will support, because it requires a significant OPEX, CAPEX costs, just the human power needed to launch the network, support this network. If in the future you will consider that some particular network have to be shut down, that will even create much higher tension and a headache. So how right now you're considering which networks you will add to Amina Bank portfolio?
So similar to what John is saying, we do see customer demand. So our front office continuously chats with their customers and says, you know, and they would approach us as well and say, hey, we hold specific asset, you know, when, basically, right? And we're like, okay, that's interesting. So that's signal number one. Signal number two, another client comes, we can always discuss size, and then usually that would trigger a process internally that would basically make us look into a specific network. I would say that top 100, top 200 are always tracked, so we're pretty much up to date with what's going on. If it's something a tiny little bit more exotic, then it would require additional research and review. But I think the more interesting conversation happens is when we do get certain pings from our customers, and then there's also certain market dynamics, and then we start to think, okay, what would that service offering would be? And a very good point, a very good example would be so Hype ecosystem. So as you know, it's a very interesting infrastructure, right? So the dual chain setup, the fact that you have staking, most of the users don't sell Hype, so they just acquire Hype, they keep Hype. There's you know, you can have a burn mechanism, so 97% of revenues go back into, you know, buyback and burn mechanics. And then the questions that we get from our customers and then from other folks within, you know, prospects, etc., is, I'm happy to bring you my Hype. I want that Hype staked, and I want to borrow against that Hype, right? So effectively, what we need to have is some type of an LST setup, which would effectively create an interesting Hype dynamic within the bank. So customer comes, deposits, doesn't really trade, maybe buys some more Hype with us. It's constantly staked, yet the customer requires liquidity because whatever asset is going into the lending product with us has to be liquid. We cannot tolerate, you know, bonding and unbonding time periods. So then that triggers, okay, what type of an infrastructure do we need to have in order for us to support this? and I'm looking at your Fireblocks, we would really appreciate hypercore integration, not just hyper EVM. So let's discuss.
Let's take it offline.
Let's give it offline. All right.
But that is the process, I would say.
All right.
We've actually also had conversations with like companies active on Hyperliquid, and they said the same thing about the user behavior. Everybody, like even their own, like they have their own token, and they actually had to factor that into the behavior of their own token. They're like, it's hard to beat the value accrual of Hype on this chain. So if you're not interfacing with it in some way, they actually have like a Hyperliquid treasury. Then your token has no place there. I find that really interesting. It's a super exciting ecosystem for this cycle, I think.
It's long-term alignment with the token. I have never seen more fanatical in a good way alignment across, and we interface with all the major protocols on Hype as well. It's really it's a great product to begin with. And then you have this incredible alignment with the token, with the upside of the token, both from the actual system and the token holders and everybody who's launching products on top of Hyperliquid. It's tremendous. I've never seen anything like that, and it just goes to show that potentially, I think if we go back in time, maybe this long-term staking alignment was the right approach to ecosystem development. It just hasn't really developed in that way, and then Hype almost like iterated on the earlier blockchain ecosystem developments, and then just created something that works.
Yes, and it's a beautiful example of the right token design and usage. But while we are running to the end of this session, guys, I want to bring, someone will say, a boring topic to the table. But again, in the institutional world, it's absolutely necessary. And moreover, while we are selling a commodity product, staking is more or less commoditized product today. Custody was commoditized. Either DeFi someday will be commoditized. Clients making their decision based not on the core of the product, but on the services around, and reporting, audit, services became to be the most important things today. So we have to satisfy, well, our customers, but our customers, they have to satisfy a regulator first, auditor second, compliance officer third, and it just increase and push the bar of requirements for auditing system, for reporting system. We see how just on this area, unicorns were built. Look on the Trust Finance, which is becoming to be an absolute market standard today for reporting needs. And from your perspective, guys, representing different parts of this market, how requirements for reporting and risk attribution looks today? And Patrick, can you be the first? Because I think while we have more or less understanding on the requirements for staking, for custody, from DeFi, I believe nobody can tell what are the requirements for on-chain agentic-based tradings today.
Yeah, it's a very new space, and there are no set requirements, right? You can just make your best effort. And I think for the on-chain part, how everything executes, blockchains again are a great tool. We have them at our disposal already. If we choose that blockchains are the rails to execute agentic capital movements, then we have that trail. Then the other thing that we can do, since we are separating the agent intent and intelligence from the execution, is we can also have a log of how that interfaces with each other. Like, what was the intent that the agent produced? Did it comply with the existing client-set policy engine? Did it get applied? Yes or no? That's your execution. If no, then this is the reason why not, and that should also show up in your logs, or you should have two different versions of this. Mm-hmm. And I think once you do that, you're very set. in the future, the whole like 8004 agentic identity, like KYC trails, like Chainlink is working on that. We've been working with Chainlink quite extensively last year as one of the design partners for their CRE product for an agentic workflow. But they're also obviously deep in the permissioned version of DeFi route right now, where there should be like an attributable trail of an agent's transaction that can be tied back to the entity or person that the agent transacts on behalf of.
All right. So what it says that it's what I'm trying to understand, because it sounds very similar to where staking reporting was like 2-3 years before, when clients were fine. They were not happy, but they were fine with getting just a list of logs and on-chain records. But with the scaling on their end, with the increasing of a variety of their staking operations, bringing then liquid staking to their portfolio, it stops to work. And what today they absolutely strictly require in our market, they ask for explanation.
And we're doing that as well. And obviously in the days of AI, that also gets easier to produce. I would put that more on the UX side than on the like compliance side, because compliance is all about proving what happened and making that all traceable. And this would be somewhere in the middle. I do get what you're saying, though I wasn't really compartmentalizing that in the same bucket. So yeah, totally. You need to do that as well. You need to have like, this is how the markets develop. This is why the agents did what they did. All of that. Yeah, totally.
All right. Interesting how in the future auditors will try to standardize reports from agents.
Yeah, we're going to be on the forefront of that, I guess. Happy to talk to them.
Yeah, we'll see. All right, John, from Fireblocks perspective, I can imagine how complex it looks like in an attempt of trying to orchestrate multiple services and wrap the single report to your customers, again, operating in the multiple zones through the multiple jurisdictions. So what you are still missing, what are the biggest challenges today from the Fireblocks end on that side?
Yeah, like I think, yeah, not a salesy pitch, but we acquired Trez, right, for this exact reason, Trez Finance. So like from our perspective, we were having lots of customers who were regulated entities pulling data, but then having an issue with getting the blockchain based data into accounting standards, basically. And if you're a regulated entity, and particularly a publicly listed entity, you're doing this reporting on a quarterly basis. So I think that kind of accounting audit reconciliation offering is now a core part of the infrastructure stack for digital assets. And I think as more regulated firms are stepping into this space, it's going to be pretty much a non-negotiable. So I'm thinking like payments companies, banks, other types of regulated institutions, to make sure that you can get everything in your right accounting format is going to be pretty crucial moving forward. So like from our perspective now, we think we've got a pretty comprehensive stack for reporting in that context. But again, like it's a matter of doing the implementation and integration correctly. So that's that piece. So I think we've added a lot to that capability, but there's still a good way to go for many of these regulated institutions moving into the space.
Thank you. And Pavel, from your perspective, does your regulator already get a clear framework for reporting, or probably you're still facing some hidden zones?
No, we incredible reporting from our side, and then we even get comments from the regulator that on occasion our punctuation is not correct, but no, jokes aside, we have to, right? So we go through both internal and external audits quite regularly. So I think if there's something that we're really good at is definitely reporting and making sure that everything is documented. We have to, right? Because it's that comes the scrutiny comes with a license that we hold.
All right, guys. So we're coming to the last part, and that would be same question for all of you. And just to bring more context, there are more than 30,000 people currently watching our podcast. And I believe there are many of institutions here who are still not in crypto, who are still not in Web3, and who potentially will make their first steps soon this year, next year. And from our end today on the P2P side, when we are bringing new DeFi yield products to the market and try in my attempt of overviewing a size of potential market, I already see more than 20,000 of companies whom we consider as a potential clients and who are not in crypto yet today. So that means that thousands of businesses will make their first steps. And I want to ask you to help them to be aware and to be protected from making mistakes. So if each of you can tell what institutions currently and their way to DeFi and their way to staking and their way to crypto world, what they're doing wrong for their first time and what they have tried to avoid in their path, that would be the useful advice for the end of our session. So Patrick, if you don't mind, go first.
Absolutely. So I would say the two pieces of advice I would give is move slow on exposing yourself to risk if you're new to this space, and move quickly in terms of familiarizing yourself with the infrastructure that you're interfacing with. Because as we earlier said, eventually it's not going to be DeFi, it's going to be finance. This is just the upgrade of the financial rails that we are living through right now. And you are going to be left behind if you just brush it off as these are the crypto people. No, they're not. Like all the big banks, they're all interfacing with this. They are working with Canton, they're working with Ethereum. And our future is probably going to be a mix of different change and different settlement methods. And yeah, I would say, be curious enough to interface with the infrastructure and don't get discouraged by, the cycles, the cyclicality of decentralized finance and stablecoin demand, where the yield will fluctuate, right? Like right now, it's like 3%-ish on Aave, which a lot of people are saying, well, that's not worth even exposing myself to this new risk. Yes, indeed. But I think there's a bigger risk in just ignoring it and not exploring these new technologies.
Thank you. Great perspective. John, what you will advise?
Yeah, listen, I think for companies moving into space, what did they get wrong first time? I think building infrastructure for your first use case is not the way to go about it. So I think you need to build your infrastructure and your operating model for where you think you are in 5 years. Because if you can deliver against the first use case, but then not support 2, 3, 4, 5, you're going to have to re-platform eventually. So I think that's a really important thing that we've seen for many of the early movers on the banking side who are now re-platforming. So, it seems like a big upfront decision to make a big decision on infrastructure. But I think that's the key piece. So for serious firms who are moving into the space, it's like building the stack and the operating model for your strategy 5 years from now, not your one initially. I think that's going to save people a lot of money in the longer term.
Thank you. That's a beautiful take. And Pavel?
I would advocate for actually more close-ended sandbox POCs between traditional finance and DeFi players, because I think both can learn from each other. Just make better products in the end. And I will also, for those of you who are still, a little bit worried about moving in the on-chain world, we had a very interesting conversation with, I'm not going to name names, but I'll leave you with a hint. It's a bank that banks other banks. And they are quite active in the space. And, their dilemma is they're saying, well, we know how to move billions on chain and the systems are good and they're steady and the operationals, but we haven't figured out how to move trillions yet. So once we do that, we'll start moving. So it's coming, right? We just have to to create better products, more more safe, secure systems, processes in place. And I think that comes from co-creation, iteration, co-design initiatives, which we need to execute on. So
thank you. And from my end, I will advise just to make your first step very, very, very quickly. Make it very small, but make it as soon as you can, because while you will do it first time, you'll see that you have everything you need on place already. You have infrastructure providers, you have service providers. It's not complex anymore as it were years ago. And when in the P2P we are hiring people, employees to a company, we always giving them a ledger with 100 bags in and asking them to stake and then unstake and withdraw their assets, and that's how they can get access to these 100 bags. And it brings non-Web3 people to Web3 world within one single day, because they losing their stigma, which still is in crypto. So just take a small little risk for 1,000 bags and make something in Web3, and you will see how smooth it works already today. I want to say huge kudos and thank you for all of our panelists. And today it was a beautiful discussion, and it was extremely helpful and interesting for every of us. To our viewers, I want to remind that a record of this session will be created on p2p.org and on our socials. So feel free to come later and watch once again any section you missed today. So thank you once again, guys. Wish you great luck and success on your crypto and digital asset journey. Thank you. Goodbye.
Thank you, everybody.
thanks everybody.